All right, hello everyone. Welcome back to the channel. Another trading week in the books, and here we are looking at the SPY, the proxy for the S&P 500. This week, we talked about potential upside off of this low. We said this was likely going to be a reversal day, and we did get that upside. And the first thing you want to do is put fibs on your chart when you see a low like this. So you can see the 50 and 61 are typically the most important. Those are the ones that I really look at. I don't really care about the others. So I have the others disabled. I use the 50 and 61. Whenever you have a market that is in this type of condition and you see a potential low, you need to put these fibs on your chart. They can help you kind of guide you through the price action and not make it seem super choppy. It gives you a better read on what's going on. A lot of people probably got torn up this week, especially a lot of newer traders that haven't really seen this type of action. Traders that, even traders that were active during these times back here probably had a better time understanding this price action. But, if you started trading here in the last 3, 4, 5 months, you probably struggled reading this price action. You may have blown your account. And, I'm going to give you guys some tips, right? So first of all, if you're a newer trader, I'd recommend not even swinging in these conditions. It's very difficult. It's very emotionally scarring, honestly. It's just very difficult to stay in positions when you're ripping 100 points one day and you're down 100 points the next. It's very difficult. But essentially, if you're going to swing in this market, you have to put on a trade. Whether you want to, you see this bearish candle at the 50, right? And on the next day, you get a retrace and you want to put on a short. That's a short that you could have taken and it would have worked. That one actually worked pretty well, but it's not always going to work that well in this type of market. If you have a short position, you have to keep your stops wide and you have to keep your position sizes down. Keep your position sizes down, because a loss because of the wide stop can turn into a really, really large loss, right? If you're using your normal position size. So you need to scale down because as the market's volatile, you'll make more and you'll lose more. So keep that in mind if you're going to try swinging in this market. I think I said last week that I don't recommend swinging, and there's just no need. When you go down to an intraday chart, when you have rips like this followed by dips like this of a $10 drop right after a $20 rip, why do you need to swing in this environment, right? Just play the intraday moves. Don't get torn up. Just look at the price action for what it is, right? If we go through this week's action, I just want to look at a 15-minute chart real quick. And so off the lows, right, we have this, potential reversal day, and it did turn out to be a nice reversal day. And the next day, a lot of people were still quite bearish. But if you look at this 15-minute chart, right, this is what you want to see. Be careful trading the open. That's all I'm going to say. Be careful trading the open in this environment. Wait for the market to kind of show you what it's going to do. Wait for the market to create its opening range of the day and see how the market's reacting based on where it opens. So Tuesday it opens here and we come down, and what are we doing? We're filling this gap, right? Always keep in mind where the gaps are. So we gapped up a little bit, we come back to fill it, and now I want to see, okay, are we going to hold the gap, or are we going to get below and start trading below the gap, trading below this level here? That would be significantly more bearish. That would send us likely back down to these lows. But you can see as the first hour presses on that we're holding above the gap, simply going sideways. And so in this type of environment, you maybe put on a small position here on the long side after you see this confirmation. And then once you get the breakout of the opening range, which would be right here, then you can put on additional long size, right? And you can see that trade works out nicely. You have a 50% fib. That's a very nice target, and that ends up hitting on the next day. So nice trade, and you don't even have to swing that either, right? You can simply buy it while it's flagging here after the opening range break, sell it at the end of the day if you don't want to hold, and there you go. You have a nice profit. And again, the Fed cuts rates right here on Wednesday, right? The Fed cuts rates. It's supposedly supposed to be bullish, but no, you have to realize where we're at, where we come from. We've come from here very quickly, and we're at a big 50% retrace. Maybe we spike up to the 61, but we didn't. And if anything, that's more bearish than it is bullish. A stronger market gets to that 61, and an even stronger market gets above and probably goes to new highs. So this is not bullish right now. It's definitely bearish, big picture, and we have to see that. And so we see the rejection, and we see a recapture, right, down to the lows, and that's bearish, right? That's bearish. So then you play the downside. It's a false break. You go down to a smaller chart, find a good entry, play the downside, and there you go. You have another nice intraday trade. The next day, you gap up, and there's a gap down here. But if you just wait for a while, you'll see that the market is simply going sideways, right? Wait for that first hour, see what's happening. It moves sideways. Okay, wait another hour. Nothing's happened. The opening range has not broken. Keep waiting. Eventually, the longer it stays here, the more bullish it is. Why? Because we gapped up. If we gapped down and did that, for example, here, down, sideways, that's more bearish than it is bullish. A bullish reaction off of a gap down would be gap down and go off the open. If you see this, be wary of this false break. We were watching for this. We saw this up move, indecision, and boom, straight back down, recaptures this level right here, the opening range high. And boom, that's where you retrace, enter short. So you can see just by looking at the opening range, looking at the price action for the first half hour, give it some time, you can catch these rips and dips intraday and have no problem making money. It's really quite easy if you're just patient and you wait for the right time to strike, okay? Let's get into it now. Big picture, what is going on? Well, right now we have to treat it as a very, very big range. We have the top of the range around the 50% retrace. We have the bottom of the range down here. By the way, these levels that I have on here, they're gotten from a weekly chart. And all I've done is simply, I've marked the lowest candle closes on all of these pivots. So you'll see up here, it's the candle close on this pivot high. Right here, it's this candle's close on this pivot low. This pivot low, it's the lowest candle close, lowest candle close. And then I kind of found a few in here that seemed important based on candle closes, right? This one back here. So, and you can see they act pretty well, right? Look at an hourly chart. They do act pretty important to the market. They're not always going to be spot on intraday because they are weekly levels, but those are the important levels right now. Right now, I have to say that I think we are not going to go lower immediately. And that's what you have to realize about this market. A lot of people think that the market's just going to go down and then make a little, dead cat bounce and boom, it's going to die again. That is not how the market works. That is never how the market has ever worked. And it just doesn't happen like that, unfortunately. So one thing I noticed at the end of the day, right, you've got, look at this, high volume buying, incredibly low volume on the sell-off, and you've got a huge surge in volume, not just a little 10-minute short cover, but you've got a solid 45-minute session of buying into the close. If you look at the VIX volatility got crushed at the close, right off of if we go to a longer chart here, a very important level around 50. and it got absolutely crushed into the close. We didn't end up closing over these high closes over here. So the candle closes, the highest one here is about 43. It closed at 41.94, so it has not broken out on a weekly chart. Daily chart, huge rejection, double top, crushed into the close. This is telling us the market is going to go higher early next week. That's just my opinion here. Now, it's very possible that we can retest these lows maybe before we bounce more, but just based on those things alone, this market's telling me at the very least we're going to go up and try and fill these two open gaps here at the very least. So early next week we have to be watching if the market is up near these gaps, how is it acting? If the market is gapping down, we're likely going down to this low at 285. How is the market acting there? Most likely a bounce. When you get this large steep pattern come up and kind of roll over, usually you're going to get some buyers here. You're gonna kind of mess around, consolidate in here. There's going to be a lot of balance, and then eventually you break down or you break up. Most likely we're going to end up breaking down. And let's get into some weekly charts and look at the other sectors and explain why that's possible. The S&P weekly chart. Here's the major trend line on the S&P weekly. You can see we've had a breakdown below the 50, and this is what I like to call a pivot candle, not your traditional sense pivot candle at a high or low, but this is showing a pivot that happened midweek that is confirming the down move. Whenever you have a big move somewhere and then you have an inside week, or maybe it goes slightly lower, but when you come back up and try to retest a retracement of that candle and you reject, that is usually confirming the down move that happened. It doesn't mean that the next week is necessarily going to be down. It can be, but it is confirming the sentiment, right? It's confirming that it's likely that a further down move will come from this. We closed red, we closed under the 50, and that's not good. It's definitely not good. This trend line comes in, as you can see, right around the 200. As it rises, if we don't fall right away, there's a lot of pivots down here. You can see where the very strong support can be. It's right around 275 to 270, right in this area. Just below you have 265. So that's quite the large drop. It's another $10, $15, $20 from the lows, and it is very possible, right? We cannot discount it. This market is showing bearish signals, and we have to be ready if the market continues to fall, that we can see 275, 270 rather quickly. Excuse me. So we have to be ready for that, right? Again, on the upside, keep an eye on these gaps. If we come to fill them, how are we acting? Are we rejected very hard? Do we trend down after that? That's very bearish. Do we come up and try to fill the gap and we miss it? We can't even fill it and we reject. That's extremely bearish. Or do we come up, fill them, trade through them? What would that mean? We're likely going back to the 50% retrace. If we come up, fill this gap, and we start trading above it, and we look bullish, volatility's dying down, maybe we're just going to trade around in here, and we might make a little run for this gap at the top before potential another move down. This can take a long time. The market needs to digest this move. It was a very large move. I don't think the market's ready to make another big move down, but we can't discount it because this market is not very garden variety. Okay, let's look at some sectors. These small caps, there's a lot of these sectors, guys, that are big trend lines, right? Look at this trend line support right here on the IWM, and this is kind of adding to a potential, right? It's potential bounce. It can bounce. I'm seeing short-term bounce signals like I showed you on the volatility and the SPY. This isn't necessarily a bounce signal. You can see the IWM actually closed weekly below. It closed above this lowest price pivot, but we do have a new closing low. So that's not necessarily bearish, not bullish. They did save this low at the end of the day, just barely. And we are above the trend line. But again, we have the down candle and we have, this pivot candle that is confirming the bearish sentiment. It's very possible that we stay here for a couple of weeks though, right? That's totally possible before breaking down, let the market digest the move. We can definitely see something like that, and we should not expect immediate movement. If it happens, great, get on board, but don't be buying options that are expiring a week out and expecting the market to move immediately, because it's just not as likely, right? You get big moves usually, and they have to digest for a while. Big move, digest for a while. You just have to expect that. It doesn't always happen like that, but often it does. Okay, so IWM, it's leading to the downside, right? It's bearish when the IWM is leading to the downside. It's not good for the market, but we have to realize that this can stay sideways for a bit. Until further notice, I would not expect this to be going back to the highs. We have some important levels here. Go down to a daily if you want to mark these off. It's just the top of the range, and it's just kind of these pivot highs here. If we got up on a larger move up, this is likely where very heavy resistance would come into the IWM, just above the 200, and would likely meet these moving averages right about that time as they move lower towards price. But you see, bounce off the trend line. If we get back above these pivots early next week, watch out for a big bounce in the IWM. Okay. DJT, one of the worst looking sectors. I mean, it is the worst looking sector. Obviously, we have the coronavirus ordeal and travel, hotel. These sectors have just gotten destroyed, right? And we know that. And so this is the result. In a garden variety market, though, what can we expect? What can we expect after this big of a fall, testing this big of a pivot? Right, we got the one-day bounce. Is that all she has? I would wager no. But however, the price action coming down here is incredibly bearish. The reason for that is we have a giant drop. We have this period here where the market bases, and it gets no traction on the upside whatsoever, right? Cannot get up at all. You can see this trend line comes in that I just drew. We tested just the bottom of it, and boom, we're down to the lows. So that's really bearish. And on any bounce back up here, we should be watching these levels here, the bottom of that range and then the top of the range. If we get back into the range and we start holding and we look like we're basing to go higher, that's a potential possibility. But we also need to watch this as a potential rejection area. The lower end of it, the middle of it here on this breakdown candle high, and then there's the gap up here. If they were to come fill that, notice there's no other gaps in here. There's just the gap at the top. So it's not looking good for the DJT. We've broken this weekly trend. We talked about the monthly trend that was broken. I don't have it drawn, but we talked about that a couple weeks ago, saying that was an early warning sign. And I mean, if you just look at this chart, right? You look at this chart, it does not look good, guys. It does not look good. One interesting thing, if you can make it out, this line right here, this line is a monthly trend line from here to here, and here you can see the month found support at that trend line last month. We're now 7 days into this month, guys. 7 days into the month. 3 weeks left. Can the DJT close above that trend line and continue forming a bull flag? I'm going to be watching that. I'm going to be watching that like a hawk at the end of this month. If we're breaking down out of that, that is no good. No good. No good, guys. As you can see, there's a clear breakout area right here. If the DJT is going to come lower, this is the spot where support will be found, right around 8,050, 8,000, call it. You will see buyers step in to the DJT. If you guys want to trade this, by the way, IYT is the tradable form of the DJT, of the transports. IYT, it has options on it as well. I don't know how much volume there is, but this is how you can trade the DJT if you wish. Yeah, so DJT, I'm going to be watching that monthly close. We are at pivot lows, another reason why we can see a bounce, but overall the price action for the past 2 weeks has been very bearish, does not look good. Again, sideways action can occur here, guys. We can stay within this range. Similar to the IWM, we can experience quite a bit of chop. The market, I believe, just hasn't digested the move enough yet to break out of its current range. SMH, good proxy of the tech space. We've got semiconductors. This one has been showing relative strength similar to the Qs. All tech has been kind of bought up a bit faster than other stuff, and probably one reason for that could be that tech companies often work from home. They aren't really affected by this coronavirus at all. I heard someone say that. I think that's probably a big part of it. And I think if the market is going to see a bounce, especially a good bounce back up to the 50% retrace on the SPY, you should look for tech to be leading the way on the upside because of the relative strength they're showing. So you want to be playing your AMDs, NVIDIAs, your Apple, your Facebook's not looking as bullish, but Facebook is, just while I'm talking about it, Facebook is at a very big weekly support here. Facebook actually could be good on the upside if we do get upside here. So that's one for you. But back to the SMH. If we see upside, where can the SMH get to? Well, we have the top of the range that is created. Getting above this, closing daily above this range, we're likely headed to try and fill this gap. But you're going to have these moving averages coming down here. The likeliness of that, I'm not sure. We have to see in real time. It's very possible if the market gets that rally, tech is in a better spot, and we could potentially see that rally up to fill the gap if we get that upside. On the downside here, this is a weekly. Excuse me. Weekly. Here's your weekly trend lines on the SMH. So still holding above. It actually looks pretty all right. It's above the 50. It's still above both of these trend lines. So we had a nice little triangle. We broke up, and we're simply retesting. So you can see that tech just looks incredibly strong compared to the rest of the market. It's really holding up well. So if we do see upside, definitely stay focused on tech. Try not to play other things. Most other things are selling off quite hard, but tech is staying up here, and this is something to watch in the coming weeks. If these are broken, man, that's not good because this is what's holding the market up right now. And if tech comes down, man, this market can get ugly really, really fast. So I'm going to be watching these trend lines if we come down at all. But I'd still favor that we spend a couple of weeks around this zone before we potentially break down more. Again, market needs to digest those moves, but I'll be watching. Lastly, what have we not looked at? The XLF. Financials. Wow, financials. Just destroyed. Just destroyed. And, without the financials, the market will not go anywhere, right? In the upside, in the up direction or the down direction. If the XLF is falling out of bed, you better bet the market's going to be falling out of bed. So, again, we have a sector that is at a major trendline support, major, 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 from 2016, 2016, 2018, and now. So massive, massive, massive. This is going to be a big couple of weeks. I mean, this could get so ugly, guys, so ugly if we end up breaking these. If tech ends up breaking down, this market could just come flushing down. I mean, it could get really bad. But again, we're above right now. We're above on everything. So we have to be aware that more chop can continue, more bounces can continue. We can go up and try to test that 61.8% retrace until we get actual bearish confirmation. We have to be aware that bounces and consolidation can happen. We cannot go full bearish, right? There's so many people out here that are full bearish. You cannot do that. There's no reason to. The longer term charts are not telling us to go full bearish. They're just not. Nothing about these charts is telling us to go full bearish. The steepness and the velocity of this move has created so much fear and so much panic. And, maybe it's true. Maybe this is the start of a recession or whatever, but we don't know that. And right now, we look at the technicals for what they are. We haven't had any severe breakdown, any severe long-term bearish looking breakdowns. Okay. We don't have tech breaking down. That's telling us something. Why is tech not getting destroyed with the market? I think that's definitely it's on my notepad, right? I'm watching that. Definitely watching that like a hawk. If tech is going to stay elevated or if that's going to come down, because that would not be good. But I think it's trying to tell us something personally, and I'm going to be watching tech in the upcoming week or two and seeing how it's moving with the market relative to the market. But the XLF, I've got levels. I've got levels on everything. If you guys want to mark them down, they are all very important levels. I try to put the most important levels on my charts and keep the noise to a minimum. So here you go. Barely held that trend line. We shouldn't be surprised if the XLF can get back over this, go and fill this gap, go and fill this gap. How does it act at those gaps? How does it act? Every day when you come to trade, whatever you're trading, does it have a gap? Is it trying to go to the gap? How does it act at the gap? You just pay attention to those few things. Your trading will improve immensely. That's all you need. Look at the opening ranges, keep in mind where the gaps are and how it's acting around the gap, because price wants to fill gaps. If a stock or a security gaps up or down, and it's maybe, say the XLF gaps up here and it's right here at the open on Monday, what is it likely trying to do by gapping up? It's trying to fill this gap. So you should expect it to try to fill this gap, and then be paying attention. How it's acting. Does it come in very quickly and get rejected, or does it kind of just lull its way up to the gap? Or does it completely just shoot through the gap and then is holding up there the rest of the day? Then it's likely going for the next gap. right? Price action can tell us a lot. Okay, so that's going to be it for this week. We should expect a continuation of this rodeo ride. Obviously, getting below these lows can send us flushing down to 275, but I would favor a bit more consolidation. Potentially, one more leg higher is very possible, but we just have to see how the market's acting early next week and go from there. Okay. Thanks for watching, guys. Please drop a like and a sub and share this with anybody that could use it in these tough, volatile times. Thanks for watching. See you later.